Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Incorporated. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. And while on my website, click on my podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, and Amazon Music. All right. If you have a traditional IRA, you've probably spent a good amount of time thinking about how to build it up, contributions, investment choices, compound growth over time. But there's another side to the conversation that doesn't always get as much attention. And that's how and when you actually take the money out. Because it turns out that the decisions you make about withdrawals can matter just as much as the decisions you made while you were saving. So, the timing, the amounts, the sequence, all of it has the potential to affect your tax bill, your Medicare premiums, your Social Security benefits, and ultimately, how far does your savings go? So today, we're going to walk through 7 things everyone with a traditional IRA should understand about withdrawals. And I'm joined by my co-host, Tony Shore, who helps keep these conversations practical and grounded. Hey, Tony, how we doing, buddy?
We're doing great. I'm doing great anyway. I've had a great week. Sounds like you've got a great show lined up for us.
Yeah.
And this is interesting because a lot of people end up in retirement with a traditional 401k or IRA, and typically they need to move that 401k into an IRA.
Mhm.
So how do you create income from that? What do you need to know about withdrawals? There's a lot of expensive, costly mistakes that people make when it comes to this step and this part of retirement is the withdrawals they take from these accounts. And a lot of people don't understand all the rules, and there are many. A lot of them have to do with taxes, so we'll dig into that here in a minute. First, how have you been, Albert? What's going on over there? I noticed no sling today. Your arm is
Yes, I got
getting
doctor
better.
approval that I no longer need the sling. I'm a little ahead of schedule with my recovery, so things are all good. And I can raise it about this high and say hi to everybody now. So not bad.
Not bad. Not bad at all.
Yeah.
That's awesome. Well, good for you. I'm glad it's healing nicely and everything's looking better. I was just surprised to see you today with no cast on. It's been a
Right.
while.
Yep. Yep.
Yeah.
Feeling
Well,
good.
well, hey, this topic that you have for us today, I'm excited about it because I think a lot of people might understand the basics of how an IRA works, a retirement account works,
Hmm.
but at least on the savings side, it's easy. The rules around withdrawals, that's where
Mm.
things get more complicated and somewhat nuanced, right?
Yes, that's exactly right. And we're going to try to make those nuances as clear as possible. Now, the source we're drawing from today is a US News and World Report article that is titled 7 Things to Know About Withdrawing Money from a Traditional IRA. So let's go through them one at a time. The first thing to understand is that withdrawing too early comes with the cost. The government imposes a 10% tax penalty on money withdrawn from a traditional IRA before the age of 59 and a half. And that penalty is on top of the ordinary income taxes you also owe on the withdrawal.
Oh, wow. Okay. So it's not just 10% then, it's 10% plus the tax rate, right? So on top of
Exactly.
the taxes.
Yep, exactly. And, the
Wow.
article gives a useful illustration. So, for example, for someone in the 12% tax bracket, taking an early withdrawal could mean losing close to a quarter of the amount between the penalty and the taxes owed. Now, that's a significant hit on money that was supposed to be growing for retirement. So now that 10% penalty exists for a reason because it's designed to discourage people from tapping into the retirement savings before retirement. And as a general principle, it's sound, but there are exceptions. And we'll come back to those later in the show.
Okay. Makes sense. Is there a rule of thumb, though, for when an early withdrawal might actually make sense
Mm.
despite the cost or not?
Well, it's a question worth asking because there are situations where the math could work out. Like, let's say a genuine financial emergency, for example, where the alternative is high interest debt. But I encourage anyone in that situation to look at all the options first. A 10% penalty on top of income taxes is a pretty steep price. And once that money's out of the account, well, you lose the compounding that would have happened, on it for the rest of the retirement. So that's a cost that doesn't show up on the withdrawal slip, but it's a very real when it comes to having it over time.
Yeah. Well, it is real. And I think that's really important. So what's the flip side of that, though? What happens if somebody waits too long?
Well, that's the second thing. And it's one I think catches people off guard all the time. While taking withdrawals too early is costly, waiting too long has its own drawbacks as well. Everything that, let's say, comes out of a traditional IRA is 100% taxable as ordinary income. So ideally, you want to time your withdrawals for lower income years when you're in a lower tax bracket. So for a lot of people, the early years of retirement represent exactly that window. Income may have dropped. You're not yet drawing Social Security, and there's an opportunity to take distributions at a lower tax rate than you might face later.
Right. Well, and I think that makes sense. It's also when that Roth conversion might make sense for some people. I know we've talked a lot about Roth conversions lately.
Oh, definitely it can be. In fact, a Roth conversion means taking money out of your traditional IRA, paying taxes on it now, and then moving into a Roth IRA where it can grow tax-free, and future qualified withdrawals may come out tax-free. So the article specifically cites age 55 to 65 as the sweet spot for that kind of conversion. Now, the reasoning is that by that point, children may grow up, let's say, be grown and out of the house. There may be, let's say, additional flexibility in the budget to cover the taxes on that converted amount. And you're still far enough from required minimum distributions that you have time to let the Roth account grow. So it's also worth noting that withdrawing from a traditional IRA before age 70 can be a way to delay claiming Social Security as well. So for every year you wait past your full retirement age up to age 70, your benefit may increase by approximately 8% per year. So using IRA funds as a bridge while you delay Social Security, well, it's a strategy worth understanding.
Yeah. Yeah, and I think it is. Now, before we go any further, Albert, let our listeners know how they can reach out if they have questions or want to set up a no-charge consultation with you.
Yeah, folks, if you guys are wondering about how to take distributions and what we call mailbox money, give us a call, 586-752-7008, or visit us online at www.kaizenfinancialinc.com. Scheduling is easy, and we're always more than willing to show you what your numbers look like.
Awesome. Okay, so let's continue this discussion on IRA withdrawals in retirement. What's the third thing people need to know about that?
Well, required minimum distributions, or what we call RMDs for short. Once you turn 73, the IRS requires you to begin taking annual withdrawals from your traditional IRA, whether you want to or not. Now, the reason is straightforward. The money in a traditional IRA has never been taxed, and the government doesn't allow that to continue indefinitely. So missing an RMD carries a significant penalty. Under current rules, failing to take, let's say, the required amount can result in a tax penalty equal to 25% of the distribution you were supposed to take. Now, that's not a small number, Tony.
Yeah, no, that's real money to you and I, that's for sure. And does that RMD amount change depending on how much you have in the account? It does, doesn't it?
It does, actually. In fact, the RMD is calculated each year based on the account balance and life expectancy factor from the IRS tables. Now, the more money in the account, obviously, the larger the required withdrawal. That's one reason why making strategic withdrawals or conversions in the years before age 73, well, it can be very valuable. And then the more you've reduced the balance before RMD begins, the smaller those required withdrawals tend to be, and the lower the associated tax is hit. Now, the article also makes an important note here. Money converted to a Roth account doesn't count as an RMD. So if let's say you're converting in advance of age 73, that's reducing your future RMD exposure for sure, but it's not satisfying it.
Yeah, true. But somebody who retires at, say, 65, they've basically got 8 years before RMDs will kick in, and they could use that window strategically, correct?
Oh yeah, I mean you got it. If income, let's say, drops significantly in those early retirement years, that gap, wow, can be an opportunity to convert portions of the traditional IRA to a Roth at a lower tax rate than you might have faced during your working years. Now, it does take some planning to do it well because you don't want to convert so much in a single year that you push yourself into a higher bracket or trigger higher Medicare premiums. But the window is real, and for the right person in the right situation, well, it could be meaningful.
Yeah, I would assume it would be. Now, what about the fourth point? What's number 4 on the list?
Yeah, this one is particularly useful for people who are charitably inclined. So if you're at least, let's say, 70 and a half years old, you have the option to make what's called a qualified charitable distribution, or what we call QCD. That's when you direct money from your IRA straight to a qualified charity, and you can do up to $100,000 per year. Now, the money goes directly from the IRA to the charity, thus bypassing you entirely. And here's the valuable part: a QCD can satisfy your RMD requirement for the year. And because the money goes directly to a charity and not to you, it may not count as taxable income. So that could reduce your adjusted gross income in a meaningful way.
Yeah. Well, and so instead of taking the RMD, paying taxes on it, and then donating the remainder, you skip the tax step entirely that way, right? With the
That's the
QCDs.
idea.
Yeah, that's
Yes.
awesome.
Yeah. And it's a cleaner and potentially, let's say, more tax efficient way to give for those who are, well, already planning to donate. And it's not right for everyone. So, again, not every strategy is right for all people, but for people who are charitably motivated and facing RMDs, well, it's a tool worth knowing about. That's for sure.
Oh, yeah. So let's talk about the fifth point, which is Medicare, right?
Yes.
Medicare is a big one.
This is where it trips people up all the time. It is.
Yeah,
And
we
this
were
is,
talking about this. You were saying, hey, when I get to that age, this is going to be a
oh,
problem.
yeah.
Yeah.
And, well, this is one that surprises a lot of people and affects a lot of people because they don't plan for it. IRA withdrawals count as income. And if your income crosses certain thresholds, your Medicare Part B premiums go up. This is called IRMAA, which stands
Oh,
for
Aunt
income.
Irma.
Yes, Aunt IRMAA, which is income related monthly adjustment amount. So that's what IRMAA stands for, income related monthly adjustment amount. So in 2026, the standard Part B premium is $202.90 per month. But if your modified adjusted gross income exceeded, let's say, $109,000 as an individual or $218,000 for a married couple filing jointly, well, you'll pay more. Why? Because the article notes that monthly premiums can range from $284.10 up to $689.90, depending on the income level. So that's a wide spread. And a large IRA withdrawal in a given year could push someone into a higher IRMAA tier.
Wow. Yeah, and Irma can really hit people hard. People don't understand this. This is one of the aspects I'm glad you brought up, Albert, because
Mhm.
I didn't understand this, and I have a family member, an uncle who didn't get this, and it's because um, what happens is it can go up. People think that, oh, in 2026, Medicare Part B premium is $202.
Right.
And it's the same for everybody.
Right.
Wrong. If you have too much taxable income in retirement and you're like, well, I'm not working, how will I have income? Well, you have to take out money to live on.
Yes.
Plus, if you're over 70, if you're in your 70s, you're forced to take money out of that account and pay taxes on it.
Mhm.
But it can go all the way up to over $600 a month. I mean,
Yes.
you want your Medicare premium to go from $202 to $602? You
Yep.
don't. So there's a timing wrinkle here too, though, isn't there?
There is. In fact, Medicare looks back 2 years when setting your premium levels. That means your 2024 income actually determines whether you pay a higher premium in 2026. So a larger than usual IRA withdrawal in 1 year can have actually a ripple effect on Medicare costs 2 years down the road. So that's a connection worth understanding when you're thinking through withdrawal timing.
Yeah. Well, timing is everything when it comes to all of this stuff, right? And a single large withdrawal in 1 year is going to have consequences that could stretch out 2 or 3 or more years down the road, right?
Oh, yes, it can. And that's exactly why looking at withdrawal in isolation, so just asking, what do I need this year, can lead to actual decisions that cost more than they needed to. So the more useful frame is to look at projected income across several years at once and ask where the low cost windows are. In fact, that kind of multi-year income planning is one of the things a financial professional can be generally useful for, because the interaction isn't between IRA withdrawals, Social Security, and let's say Medicare premiums are hard to model without laying it all together.
Well, right. What about the six? Let's move on to the 6 point, which is Social Security. How does
Mhm.
that affect? Why would that be in a discussion about IRA withdrawals?
Well, this one is also easy to underestimate because the Social Security Administration uses a figure called combined income to determine how much of your benefit is subject to income tax. Now, we call this provisional income. Combined income is calculated by adding your adjusted gross income, any non taxable interest, and half of your Social Security benefits. Now, the article frames it simply: every $100 you take from an IRA is treated like $100 of earned income. That means a large IRA withdrawal can actually push your combined income above the thresholds that trigger Social Security taxation.
Yeah. Well, walk us through those thresholds, though.
Okay. So for a single filer, once combined income exceeds $25,000, so up to 50% of the Social Security benefits can be subject to income tax for every dollar over that, up to 34. Now, above 34,000, now it goes to 85% of benefits could be taxable. And that's for single filers. For married couples filing jointly, those thresholds are $32,000 for 50% and $44,000 for the second tier at 85%, respectively. So these numbers have not been updated for inflation. And I'm going to tell you this, Tony, in a very long time. We're talking over 40 years almost,
Yeah.
which means they capture more people than they did what they once did in the past. Because now we make more nowadays, and the numbers I just explained was back in the 80s and 90s. Today is 2026. So this is another reason why thinking strategically about the size and timing of IRA withdrawals can actually matter beyond just the immediate tax bill.
Right. That's the immediate tax bill is always the concern here, right? I mean, it
Mhm.
seems like that's what we're talking about. But before the final point, Albert, let's remind listeners one more time how to get a hold of you.
Yeah, of course. If anything we've talked about today has raised questions about your own IRA strategy, hey, we'd love to sit down with you. Just call our number at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. Schedule a complimentary consultation so we can show you what your numbers look like.
Sounds good. Sounds good. So, what's the last point? The seventh point.
Yes. So this one is about early withdrawals, and this is worth knowing even if you're not planning to use it, because life doesn't always go according to plan.
Yeah.
Now, while the government imposes, let's say, a 10% penalty on early IRA withdrawals, there are specific circumstances where that penalty does not apply. So the article lists several. A first-time home purchase is one of the most commonly used exceptions. Up to $10,000 can be withdrawn penalty-free for a qualified first-time home purchase. Now, other exceptions include a permanent disability that leaves you unable to work, a terminal illness diagnosis, unreimbursed medical expenses above a certain threshold, higher education expenses, health insurance premiums paid during a period of unemployment, and then qualified birth or adoption expenses up to $5,000.
Yeah. Yeah, actually, my wife and I adopted, and we got that $5,000. But income taxes still apply, even with the
Of
exceptions,
course
right?
it does. It's the
Of course.
government. Come
Yeah.
on. But yes, that's an important distinction, Tony. The exceptions eliminate the 10% penalty, but they don't eliminate the income taxes on the withdrawal. So you still owe ordinary income tax on the amount you take out. The penalty is waived, the tax is not. So there's also one more option worth mentioning here, which is IRS Rule 72T. This allows you to take what you are called substantially equal periodic payments from your IRA before age 59 and a half without triggering, I should say, the early withdrawal penalty. So the payments are calculated based on your life expectancy, and we must follow specific IRS approved methods. Now, the key caveat is that once you start a 72T distribution schedule, you generally cannot change it until age 59 and a half or until 5 years have passed, whichever comes later. So modifying the schedule after it begins, well, it can result in retroactive penalties being applied. So the article's guidance is clear. If you're considering this route, do it with the help of a financial professional.
All right. Well, yeah, that's the bottom line. And I think, but the problem here is there's a lot of moving pieces.
Mhm.
So what's your overall takeaway for our listeners and viewers from today's conversation?
Well, I think the big picture is this. The traditional IRA is one of the most powerful savings tool available. In fact, 90% of people have one. But the rules around withdrawals are more layered than most people realize. When you take distributions, well, how much do you take? And what else is going on in your financial picture at the time? All those things interact in a way that can either cost you or benefit you. Now, the decisions don't have to be overwhelming, but they do benefit from planning. So understanding the penalty, the thresholds, the RMD rules, the charitable distribution options, and the ripple effects on Medicare and Social Security, well, that is the starting point. Building a strategy around them, well, that is the key.
Yeah. Yeah, and I think that what today's conversation made clear is that the answer to that question isn't just about investment returns or account balances. It's about income management, isn't it?
Big time. That is so correct. You know, a traditional IRA isn't a set it and forget it account when it comes to withdrawals. The government has built a specific set of rules around when money comes out, how much has to come out, and what happens if you don't follow those rules. Now, understanding them isn't optional. It's part of managing your whole retirement income well. And here's what I want every listener to take away today. The strategies we talked about work best when they're planned in advance. The Roth conversion window, the pre-RMD drawdown strategy, delaying Social Security while using IRA funds as a bridge, the QCD for people with RMDs who are also charitably inclined. None of those are last minute moves, folks. They require a view of your income across multiple years, ideally before you're in the middle of decisions with a deadline attached to it.
So the ideal time to think through your IRA withdrawal strategy is before you need to make a withdrawal, not after, right?
That is the message, yes. And it doesn't require having everything figured out perfectly. It just requires having the conversation to get it going. Sit down with the financial service professional, folks, who can look at your full picture, including your accounts, your expected income sources, your Social Security timing, and your Medicare situation. So that's a conversation we're always glad to have. If anything from today's show raises any questions about your own IRA or let's say your broader retirement income plan, please give us a call, 586-752-7008, or visit us online at www.kaizenfinancialinc.com. Remember, we can take a look at where things stand and talk through what options may be available to you so you can own your retirement.
All right. Thanks, Albert. Listeners and viewers, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everybody.